Hello, this is Agatha, and this is the lecture for Managerial Accounting, Chapter 6. In this chapter, the first objective talks about key characteristics and graphs of various cost behaviors. A cost behavior is how a cost changes based on volume. There are three common cost behaviors: variable costs, fixed cost, and then mixed costs. Variable costs are total variable cost change in direct proportion to the volume. So as volume goes up, cost goes up. As volume goes down, cost goes down. A variable cost per unit remains constant. It has a slope. So a total variable cost, which is Y, equals variable cost per unit of activity times volume of activity. So Y equals Vx. So this is where math comes in. I'd get out your flashcards and I'd make some flashcards for this chapter. You'll find it very helpful. Here's a cost graph. So you can see it's got a slope, and as the volume goes up with the dollars on the side, then you're going to get that nice slope of a graph. The vertical axis is always shows total cost, and the horizontal axis shows the volume. So here's your horizontal and here's your vertical. So here's your total volume and here's your total costs. Here's another picture of a total variable cost. So you show sales along the horizontal and sales commissions along the vertical, and then they go up in relation. Objective 2 talks about the use of cost equations to express and predict costs. A cost equation is a mathematical equation for a straight line to predict total cost. So Y equals Vx plus F. So variable cost times plus fixed cost equals total cost. Where Y is the total mixed cost, V is the variable cost per unit, X is the volume of activity, and F is the fixed cost over a given period of time. The key characteristics of fixed cost are total fixed costs stay constant over a relevant range. So fixed costs per unit of activity vary inversely with the changes of volume. So if you think about an example, when you build a car, there's going to be a certain amount of fixed cost no matter how much time it takes to build the car. So your fixed cost might be a multitude of things, and then if you can make the car faster, you would save time in labor, but you'd have this amount of fixed cost for every car. So total fixed cost Y equals fixed amount over a period of time. And the relevant range is the normal operating range of whatever activity is you're talking about. So here's your fixed cost. See how the line is the same. So when you're trying to, when you're creating something that has fixed and variable costs, where your profit will increase is where you can cut your activity down that is driving the variable costs, where the fixed cost will always stay the same. Cost and decisions. Committed fixed costs, discretionary fixed costs those are the two things. And then there's a key characteristics of mixed costs. So you have total mixed cost increase as volume increases. Mixed cost can be expressed as a combination of the variable and the fixed cost equations. So here's your mixed cost equals your total variable cost plus your total fixed cost. And here's the description down below. So here's your mixed costs. So you have a product where you have fixed and variable, so they call it mixed. And most products are a combination of fixed and variable costs. So let's look at S6-1 and talk about three products, A, B, and C, and they want you to define what the cost behavior is. So A, you can see purely variable. B is fixed, and C is a mixed cost. So you can look at the different costs per unit, and you can tell that that the different products meet those different tests. Let's talk about relevant range. Relevant range is a band of volume where total fixed costs remain constant at a certain level. So variable costs per unit remain constant at a certain level. So here's what it looks like. It looks like a little step. As you move over the number of units, this is an example where if you have units between here and here, it's going to be flat. Then it's going to jump up and be flat again. And this is what it's called step costs also. Here's curvilinear cost, where the cost is moving around, but you can draw a line between it to see that straight relationship. So let's look at 6-22A. I'm going to step away from this example for a minute and do it in Excel so that you can see really how to do this kind of a problem. Okay, the problem's giving you the units along the top, and it's telling you that the variable cost for this number of units is 5,100 and the fixed cost for the garment is 2.4. So how do you do this? Well, if I would use Excel, the first thing you're going to come up with is you know the variable costs and you know the fixed costs per garment. So you can calculate the variable costs by dividing the units into what you know. So in this, I took D6 and divided it by D5. So I took my 6,000 units and I divided it by my my variable, took my variable cost divided by my units, and I got 0.85. And then now I know my pieces, so I can take my fixed cost, which is going to be D11 times D5. Then I'm going to add those two together to get my total operating costs. And then I can come down and get my average cost by dividing my total cost divided by my units. So now I've got one whole line all figured out. Well, from here, the variable cost per garment is going to be the same under all the units. So you can just put the 0.85 in these cells. Then you can come up to the top, and the fixed cost for a relevant range is always the same by default. So you can put that in. So fill in what you know. Let's start here. Your variable cost then becomes E10 times E5. So you take your units times your variable cost per garment and you get that number. Then you can add these together to get your total operating costs. And once you get your total operating cost, you can divide that by your units to get your average cost. And then you're going to do the same thing over with the 4,500 units. You get your variable cost by taking the units times the variable cost per garment. Then you can add these two together to get the total, and then divide that total by the 4,500 to get your units. I would do these problems in Excel. If you're having any trouble in my accounting lab, you can flip over to Excel to calculate them out. Okay, so I'm going to flip through this slide because I thought it was easier for you to see it in Excel than it was to do it here. Okay, let's do E6-25A. This one they kind of spell out for you. So if you look at E6-25A, they give you the cost per unit and the number of mailboxes. So you come up with your total cost, then they tell you what the fixed cost is, so you subtract it, and the variable cost is the difference. Because remember, total cost is variable cost plus fixed cost. Then you take your variable cost divided by your units and you get your variable cost per mailbox. It's purely math. This is really math. Try not to let your brain stem away from the basic equations. So then you can come in and calculate it based on a different number of mailboxes, and you can get a different number of costs. So that's what C, D, and E are doing for you. Then they have using the average of 1,700 in F, using the cost equation, and then you come up with the difference of, depending on what units you're selling, you're going to have a difference in cost. Let's talk about sustainability and cost behavior. Sustainable companies and changes in cost behavior. E-banking, e-billing drive down variable costs. Those are some examples. And greener lifestyles. So remember, this chapter brings into the whole behavior of accounting, sustainability and cost behavior. And there's always an environmental impact that you have to come into play also. Let's talk about Objective 3, using account analysis and scatter plots. There are 4 methods to analyze cost behavior: count analysis, scatter plots, high-low method, and regression analysis. And if you ever took higher level math, you remember learning about these. Account analysis uses judgment to classify each general ledger account. Therefore, it is subjective. Scatter plots use historical data to determine a cost behavior. So scatter plot is a graph of historical cost data on the y-axis and volume on the x-axis. It helps managers visually determine how strong the relationship is between costs. Here's an example. Miles driven, total cost, and you just scatter it along, and then you can kind of see where you could draw a line between it. Objective 4 is the high-low method. The high-low method finds variable cost per unit in a slope. Then it finds the fixed cost, which is the intercept. Then it creates this cost equation. It's easy to use. It only uses 2 data points. So if you look at E6-28A, it wants you to find the slope of the mixed cost line. Now it looks back at the data in E6-27A, which I did assign in your homework. And the slope, it has you look at the calculation, and then the slope represents the variable cost per unit of activity. So if you're looking at the little chart in E27A, note that these are the high and lows. It's the miles that you're looking at for the high and the low. So you take the cost divided by the difference in the miles. So you subtract the 2 given in the problem, and you get a cost per, you get a total dollar amount divided by units. And you get a cost per unit. And that's your variable. Then you come in and you find the vertical intercept. The fixed cost equals the total mixed cost plus the variable cost. So you're going to take the dollars minus the variable cost times the units. So that's your fixed. So you're going to subtract the variable from the total, and that's your fixed. Or this was the high, this was the low. Notice they come out the same. They better come out the same or you have a problem, because fixed costs are supposed to be the same for any relevant range. Then you create and use an equation to show the behavior of mixed cost. So now you have y equals 0.23, which was your variable cost per mile, plus your fixed cost. Now you can plop anything in, any number of miles in to get your total. So here, if you're assuming 16,000 miles, you're going to take your 0.23 times your 16,000 plus the 1475 and get 5155. So you have a nice little math equation. You can use regression analysis. It's a statistical procedure to find the line that best fits the data. It uses all data points. This might look familiar to you down here. R minus square intercept x variable 1. These are the different things that you need to know to calculate. The intercept is the fixed cost, right here. The x variable 1 is the variable cost per activity, and the r square equals the goodness of fit. So here, if you're looking at utilities monthly cost equation, which is what this is down here, you're going to take the 7.85 plus the 14,538, where y is the total monthly utility cost. And then you have your x. X is the number of guests. So you can put anything in for x, and you're going to come up with a different equation. This is the goodness of fit. How well does the line fit the data points? That's the question. Ranges from 0 to 1, and that's regression analysis. So if you never learned this before, it's a topic covered in here. Definitely a more complex topic covered in higher level courses. Predicting costs and data concerns. Data concerns only valid within a relevant range. There could be seasonal variations. You could have inflation. You could have outliers, which are abnormal data points. So those are things that you need to keep in mind. No math equation is ever perfect. It's a basis. Objective 6 describes variable costing and prepares a contribution margin income statement. You might have learned contribution margin in financial accounting. There's also the term absorption costing. It's required by GAAP for external reporting. It assigns all manufacturing costs to products, direct labor, variable manufacturing overhead, direct materials, fixed manufacturing overhead, all those terms we just learned about in previous chapters. It's a traditional conventional income statement, and here's what it looks like. Sales minus cost of goods sold is gross margin less your SG&A is your operating income. Then you have variable costing, which assigns only variable manufacturing cost to products. The fixed manufacturing overhead is the period cost, and it's done for internal management decisions. So here we go, going back to talking about a company that might have this separate team that does cost accounting and then a team that does financial accounting, and they're doing different things. Well, somewhere along the way you need to reconcile this stuff. This is called a contribution margin income statement. This is what it looks like. Sales minus variable cost is contribution margin, minus fixed cost is operating income. Now you need to reconcile the two, because you don't want to throw numbers out into the world, whether they're internal or external, if you can't explain the difference. So the difference in operating income could be the change in the inventory level in units times the fixed manufacturing overhead per unit. So let's look at E6-44A. Here's your conventional absorption costing income statement, and all the data is in the chapter. So I'm just going to plop this up here so you can see what it looks like. Typical income statement, the sales revenue, the units times the sales revenue per cost given in the chapter, the cost of goods sold, this was given in the chapter, is your gross profit, add the operating expenses in, and they provide the $6, which is the sales commission, and you get operating income. Okay, then you have your variable costing statement. First, you need to calculate the variable cost of goods sold, which you had no beginning inventory in this problem. You had variable cost of good manufactured. They give you the $15 and the 225 units of production. And then they tell you what the variable cost, so you multiply those two and you get your variable cost of goods available for sale. Then you have ending goods inventory of 20,000 units times $15, and there's your ending inventory. And they give you this in the problem too, both these numbers. So you had variable cost of goods sold of $3,075,000. So now you look at your contribution margin income statement. You put in your sales less your variable costs less your commissions is your contribution margin. And then you have your fixed expenses, which is given in the problem, the $2.4 million, and your operating expenses is given in the problem. So you get operating income under here of $1.99 million. The difference between these two is $220,000. And you can prove that out by saying you had 20,000 units times $11. And the $11 is calculated based on the manufacturing overhead divided by the number of units. So you might want to print these slides out and walk through this from your book and make sure you can do this problem on your own. Requirement 3 wants an incremental analysis. Well, it's easy to do because you can take your $44 sales price less your cost. The $21 is the combination of the variable manufacturing expense of 15 plus the sales commission times the number of goggles. So this number would change, and you could plop any number in here. And then you have an increase in fixed costs, increase in operating income. So let me go back. So the decision that you would make on this would be, this is the incremental analysis. If you sold 20 more goggles, you would have an increase in operating income more of $315,000. So it would be worth it. Okay, let's look at S6-16. Here is a traditional income statement. It's just a smaller version of a problem like this. They give you the information in the problem so you can walk through how to get to operating income under this example. And then you do a contribution margin income statement and you walk through and notice that the two are actually the same under this example. Okay? Absorption costing and manager incentives. When an inventories increase, absorption costing income is higher than variable costing. When inventories decrease, absorption costing income is lower than variable costing income. And I want you to see if you can figure out what this means by working those problems. Look at the words, but then go back to the problems and notice that what they mean by this and why you can make this kind of assumption. So therefore, managers may increase production to build up inventory to maximize income and therefore their bonus. So in financial accounting, I don't know if you can remember, depending on who your teacher was, when they talked about different ways to do inventory costing, and the statement was made that you couldn't change your method of costing. It was considered an accounting change that had to be noted in the financials. This is why, because internally you could manipulate a bonus by changing those methods. And that is the end. If you have any questions, send me an email. Thanks.